Welcome to my channel. I'm Dr. Romano. Today's issue is whether or not an institutional trader is better at managing risk and trading than a hedge fund trader. Or is it that a hedge fund trader is better at managing risk than an institutional trader? An institutional trader and a hedge fund trader are very different. They could be the same people, meaning that the hedge fund trader used to work for the investment bank on a trading floor at some time of their life. But you have to remember that management is very different at a hedge fund. That's the first issue. Management doesn't exist at a hedge fund because there's no one on top of that hedge fund trader. It's their company, they're the trader, they're the face of the company, of course, and they're the risk manager, they are the person that raises capital, they're the person that deals with the clients, they're the person that deals with the auditing company and the hedge fund accountant and the administrator, etc. They have to do every part of that company. Now I'm talking about the smaller hedge funds. The big ones are no longer really in a hedge fund because once they start hiring traders to trade, they're copying the same thing a investment bank is doing. So those top 10 hedge funds and the largest ones in the world, they have trading floors just like the investment bank. It simply is that they're not focusing on so many different types of businesses, such as an investment bank does. An investment bank has the IPO desk, mergers and acquisitions. They have multiple trading floors. I'm talking about multiple, a couple of dozen at the minimum. A hedge fund, even if they are large, it's totally different. Now, of course, the average person is not going to be able to invest in a large hedge fund, and you wouldn't want to anyway, because according to my research, once they get past a certain amount of AUM, you stay away from them. And so we're going to talk about the smaller hedge funds. That's one or two people. And so one or two people trading, or maybe it's the person, one has the capital, the rich one, and the other person has the trading strategy. The person at the hedge fund that's trading has to make all the shots. They are their own boss. They have taken the responsibility into their own hands on everything possible. So if something happens, it's on them. Of course, at the investment bank, everything is so different because you have a head trader, you have a director of that particular area, you have so many more levels of management. Now that we understand the difference between an institutional trader and a hedge fund trader, an institutional trader could be someone recruited from an Ivy League school, someone that your friend was trading and you hired your other friend from the same Ivy League school, or you have some kind of connection to that investment bank, such as your uncle is the director of trading or something like that, or your father or mother could have invested $1 billion into that investment bank. Again, that happens. And everything that I just mentioned, I work there and I know where my coworkers came from. So I'm telling you my experience there. Before we continue the video, please remember, if you like my video and the videos that I create and you want to say thank you, please do thumbs up. It's right down there. Just press it. Thank you so much. So now you have the investment bank, they have an open door policy. They're continually looking for new assistant traders and perfecting their strategy on how to find the person that would actually do really well as a trader. Because just because you hire someone to become an assistant trader, they may be proficient at writing and speaking and very articulate and remember what you tell them. But you have to remember that that's a short-term memory. Someone who passes a test with an A every time has a short-term memory that's expansive. The person that has a long-term memory, the trader, the actual profile of a trader, is probably not going to always get those golden jobs. Not saying 100%, but the majority. Because remember, traders come in all different forms and sizes, from all different backgrounds, etc. You could have a history person who studies history that would actually be good at trading, or a cop. There's a correlation with cops and finance. You could have a plumber, or you could have a teacher, astronaut. It doesn't matter. They come from all different backgrounds. Now, the people that would actually be most proficient at managing their trades are people that remember their mistakes. But you have to remember, it's not just remembering your mistakes, it's also the ability to be highly visual. And that's very important. So taking a psychological test to get a job at an investment bank, no HR, don't even bother, because it doesn't always show up. Hedge fund traders, they're cultivated because that's what they want to do. And when you love what you do, you become proficient at it because you keep trying. An investment bank trader is very different because they got the job through someone they know or the school they went to, etc. The investment bank knows that those people aren't going to always last, but they keep recruiting to look for more. Now, of course, some people do last more than 5 years in the business, and some people do last 10 years and become the head trader. But think about how many people left that company and how many people that future head trader came across that quit or got fired. Because that's what it is. It's an open door policy. Oh, of course we're going to hire you, but we're going to fire you too. The most proficient ones at either raising capital or they're really good at trading, sometimes they do become the hedge fund trader and they start their own company because you have to be an entrepreneur. And not all people that get 100% all A's and go to Ivy League schools are entrepreneurs. Sometimes they're just anywhere. You'll never know who they are. And that's why a institutional trader is very different at managing risk than a hedge fund trader. There is no risk management at a hedge fund. And if they have a website that says this is who's the risk manager, it's full of you know what. Because in order to be proficient at trading, you have to know how to manage your losing trades. The person that's a risk manager is not going to help you do that. You have that innate ability to do that. You may be able to be taught a strategy, an exit strategy, but the fact is only the best will really, really understand it and be proficient at trading. I'm Dr. Hedge Fund, not because I just like to talk about hedge funds, but because I've done a lot of research. And part of being a hedge fund selection specialist, I see it in the data. I know their background, I know where they came from, everything. The institutional trader has risk management that stands on top of them. I used to work for that group, so I know how it works. So right there, an investment bank has a risk manager or risk team on top of a trading group? No, there's something wrong with that. The trader should know how to manage risk. Giving younger people opportunities is very important, but it takes a number of years to have traded in a full market cycle of 8 to 10 years. So that's why the people that make it to 10 years as trading, which is very, very rare, that's why they become the head trader. Or they're really good at smoozing with the directors. And they got rid of all their competition. Maybe they were mediocre traders. Yes, you need capital to start a hedge fund, and somehow you have to be polished and have that ability to raise capital. But you never know. Sometimes it's easy and sometimes it's not. Trust is a major issue. So would you trust a hedge fund to manage your capital? But of course, right there, you know not to invest in one hedge fund, so you need at least 10 in your portfolio. So the average person would never have $10 million to invest, because you need a minimum of $1 million in each hedge fund, because some hedge funds have a minimum investment of $1 million, etc. And so there's so many different aspects to the answer. Is a institutional trader better or a hedge fund trader better? Those are the basic outlines to what is different, and you'll notice the difference. And this is where you have to say what's better. An institutional trader is not the boss or the owner of the company, and those traders' returns will mimic that, and you could see it in the returns. The hedge fund traders' returns, they're missing that aspect of being afraid to trade, because the only person that they have to worry about is their investors. But they could always find more investors if you don't like their returns over a particular year. So in a way, it's a different type of stress for a hedge fund manager. He doesn't have someone holding his hand. At the investment bank trading floor, one, you have a lot of stress because you're worried about, maybe you're going to lose your job and not have income. Well, the hedge fund traders worked for so long without an income because they had to start in the beginning. And in the beginning, you may have to put the money that you make back into the fund because you have to pay the administrator, the attorney, and everything else, that office space if you don't lease your house. Right there, it's a different type of business, to be honest with you. A trader at an investment bank learns a strategy and does what they're told. And they are really good at doing their job. But in the data, the returns, you could see that. Now you have to say to yourself, well, how do I know what the returns look like at an investment bank? Well, I worked on the trading floor. I was the person that would review the trading books on a global basis every morning. So I knew what the data looked like. A hedge fund manager's returns don't have that correlation because they're the only person there. And so 5 levels of management, they're not affected by that. They're not affected by the fact that, oh my God, maybe tomorrow when I walk into work, I won't have a job. Or, oh my goodness, what if I lose money? No. The hedge fund manager knows that even if they lose 1 client or 5, they could always find another one because there's plenty of money out there. Secondly, yeah, everyone has a bad year or a bad quarter. That's normal. Of course, a typical person's not going to really know how to analyze those returns like myself. It's a big difference. The investment bank trader has so much stress over them that stress is correlated into their returns. Okay? They may be very proficient at what they're doing, but their returns are affected by the 5 levels of management and the stress that's on top of them. Please remember, if you like my videos, to subscribe and you'll see my future videos. And as well, please do thumbs up down there if you like my video. And please say thank you by doing thumbs up. Finally, please share my video with at least 5 people. And lastly, please remember to send me messages to live chat. I'll make future videos just for you. Thank you so much for watching.